What the Federal Reserve says and does can move the markets, and it's typically very careful about what it says and does as a result. Sometimes, however, the markets react even when the Fed's words and actions are carefully crafted. This was the case with the Fed's latest press conference, where Chairman Jerome Powell caused the markets to crash. What's strange is that the things he said should have caused the markets to rally. That's why today we're going to bring you up to speed on what the Fed has been up to, summarize its press conference, and explain what it could mean for the markets. Let's start with a quick recap. The Fed has been raising interest rates since last spring to fight inflation. This initially caused the markets to crash. That's ultimately because there was uncertainty about how high inflation would go and how much the Fed would have to raise interest rates to fight this inflation. As the months went on, however, it became clear that inflation was coming down and that the Fed was nearing the end of its interest rate rampage. And so the markets started to rally because investors could see that the next step was for the Fed to lower interest rates, reigniting the credit-driven economy. Of course, for a while, investors were concerned that the Fed's rate hikes would cause a recession, but these concerns paradoxically resulted in even more market rallies. That's simply because the Fed's solution to recessions has been to lower interest rates and start stimulating, rocket fuel for markets. This is the hard landing scenario you've been hearing about. Then, investors started realizing that the US economy was more resilient than anyone had imagined, in large part due to government spending. Naturally, this also resulted in even more market rallies because a strong economy plus declining inflation meant that the fundamentals of the economy would improve. This is the soft landing scenario you've been hearing about. Over the last few weeks, however, something changed. You see, the Fed and other central banks only control short-term interest rates, specifically the interest rates that banks use when they lend money to each other overnight. By contrast, long-term interest rates are determined primarily by the free market. Long-term interest rates in the US are determined by the supply and demand for long-term US government debt, aka bonds. When there's lots of bond selling, long-term rates rise, and when there's lots of bond buying, long-term rates fall. As you may have heard, long-term rates have been rising fast. Logically then, this means that someone somewhere is selling lots of US bonds for some reason. If you watched our video about the debt ceiling deal, you'll know that the US Treasury Department is one of these sellers. It's been selling US bonds to refill its bank account at the Fed, but it's not the only one selling. If you watched our video about China's new central bank governor, you'll know that the People's Bank of China has also been a big seller. It's been selling US bonds for US dollars to buy the Chinese yuan to prevent its value from falling further. The Bank of Japan has been doing the same thing for the yen. And if you've been keeping up with our coverage of the Fed's press conferences, you'll know that it has also been reducing its balance sheet, which consists primarily of US bonds. It's been shrinking its US bond holdings as part of its monetary policy, something that's gone almost unnoticed until now. As with the rise in short-term interest rates last year, the recent rise in long-term interest rates seems to have taken the markets by surprise and is creating a lot of uncertainty among investors. As you'll soon see, long-term interest rates could continue to rise, and this could continue to pull the markets down. It was against this backdrop that Fed Chairman Jerome Powell took the podium at the Fed's most recent press conference. Now, this press conference was particularly significant because it was accompanied by the release of the Fed's latest Summary of Economic Projections, or SEP, an updated roadmap, if you will. Jerome started by saying the same thing he said since the start of last year. The Fed is committed to bringing inflation back down to 2%. He announced that the Fed had decided to leave its interest rate of 5.25 to 5.5% unchanged for now, but has also decided to continue shrinking its balance sheet. Jerome said that the Fed will proceed carefully when raising interest rates and will make this decision based on incoming data about inflation and the economy. In practical terms, this means the core CPI and the PCE for inflation and various employment statistics for the economy. This is something Jerome has said at recent meetings, but this time he included something different. In addition to watching data about inflation and the economy, the Fed will also be watching unspecified risks. Not lingering on this point for too long, Jerome then pivoted to talking about the Fed's latest SEP. He noted that Fed members foresee the economy being even more resilient than they had initially projected. He explained that this is due to the recent GDP figures, which came in higher than expected. FYI, this is significant because it implies that most Fed members believe there won't be a recession. And it's a similar story when it comes to unemployment. Jerome acknowledged that the unemployment rate recently spiked to 3.8%, but pointed out that the Fed projects unemployment will only rise to 4.1%. As with the Fed's economic forecast, the Fed's employment forecast suggests they don't see a recession. Note that this was in stark contrast to Jerome's tone during his speech, which was abnormally cautious and even downright hesitant at some points. Things got even more interesting when Jerome started talking about inflation figures. He didn't highlight the recent CPI print as much as you might expect. Now, this was surprising given that the CPI for August had come in above expectations. In past press conferences, Jerome would have underscored this fact. Instead, he focused on the fact that Fed officials expect inflation, as measured by the PCE, to come down to 2% over the next 2 years. This not only implies that there will be no recession, but that there will be a soft landing. Inflation will come down with no recession. Recall, this is supposed to be bullish. The Fed's projections for interest rates should also have been bullish. Jerome noted that most Fed officials believe one more rate hike of 25 basis points, 0.25%, is appropriate between now and the end of the year, and then quickly noted that the Fed foresees rate cuts sometime next year. Again, this is supposed to be bullish, yet the markets crashed as Jerome spoke. Not only that, but Jerome took an uncomfortably long pause when discussing the rate cuts. Probably nothing. Jerome stressed that these projections assume that the economy will evolve as expected, meaning the GDP figures and the unemployment figures. Until then, though, the Fed will continue to, quote, significantly reduce the size of its balance sheet and raise interest rates if need be. Now, once Jerome finished his speech, the question period began. The first reporter to ask questions was from the Financial Times. They asked Jerome why Fed officials think one more hike is appropriate. Jerome said that it's all because of the economic data. Rates may not be restrictive enough just yet. The reporter then followed up with a second question, and that's why the Fed foresees rate cuts in 2024. Jerome was visibly uncomfortable and responded by insisting that the SEP is not a concrete roadmap. He then added that it reflects a stronger than expected economy, which doesn't make much sense. Now, the second reporter to ask questions was from the Washington Post. They asked Jerome whether there was an argument about raising rates one more time. Jerome said there was no argument, they were just merely discussing the data. We'll find out when the Fed minutes come out in a couple of weeks' time. Jerome also added that the recent inflation data was looking promising. This was an eye-opening comment, given that aforementioned August CPI, which came in higher than expected. From our perspective, this comment suggests the Fed doesn't think inflation is beginning a new trend higher. Make no mistake, this could very well be the case, and we'll know when the September CPI comes out in mid-October. Mark your calendars. Next, the third reporter to ask questions came from CNBC. They asked Jerome whether the Fed believes inflation will be more persistent, and whether this means that the default interest rate will be higher as a result. Jerome completely dodged the question by saying he doesn't know, nor does the Fed. The fourth questioner was from Reuters. They asked Jerome why it is that he keeps saying that bringing inflation back down to 2% will require below-trend growth, aka recession, while the Fed is not forecasting a recession. Jerome just said that the Fed is following the economic trend. The Reuters reporter followed up with a cutting question, and that's whether this means the soft landing scenario is still on the table. Incredibly, Jerome said no, a flat-out NO. He explained that a path to a soft landing could still exist, but it will be determined by factors that are outside of the Fed's control. This begs the question of which factors the Fed is talking about. Our best guess is that the answer is the Treasury Department's, or rather the US government's, spending. Remember that government spending seems to be the reason why there's been higher than expected economic activity. On that note, many of the government spending programs that were supporting the economy have come to an end, or will soon be coming to an end. The two elephants in the room are the Employee Retention Credit, which just ended, and the deferred student loan repayments, which start next week. Then the fifth reporter to ask questions was Nick Timmeros of the Wall Street Journal. Now, Nick is really the only Fed reporter you need to know by name. His nickname is the Fed Whisperer, but this time it was Jerome who did the whispering. Nick asked Jerome about inflation and interest rates. In their exchange, it became clear that Jerome has shifted his focus from inflation to the economy. Now, this makes sense given the changing fiscal situation a few moments ago. The thing is that Jerome's sudden economic caution should have been yet another bullish indicator for the markets, but it wasn't.
Sorry to interrupt you folks, but I have to let you know about the Coin Bureau deals page. My team and I have been able to pull together some of the best promos and discounts in the crypto space. We're talking trading fee discounts of over 50%, thousands of dollars in bonus airdrops, amazing deals at top exchanges, and reduced prices on hardware wallets, and much, much more besides. So just go to coinbureau.com/deals, also linked to below, and find the promo suited to you. And now, back to the video.
Now, the sixth reporter to ask questions was from the New York Times. They asked Jerome about the rate cuts the Fed is projecting for early next year. Jerome repeated that the Fed's SEP should not be taken as a roadmap, but confirmed that yes, rate cuts are coming. And yet, the markets continued to crash. The seventh reporter to ask questions was from Axios. They asked Jerome what's causing the apparently strong economic growth. Jerome said that it appears to be consumer spending. This makes sense, and it's especially relevant to stuff like the student loan repayments. Spending will fall. The eighth reporter to quiz Jerome was from Politico. They asked him a de facto follow-up to the previous question, and that's how factors like student loan repayments will affect the Fed. Jerome revealed that the Fed is watching these factors very closely, including the recent increase in oil prices. Speaking of which, you should know that if oil prices stay too high for too long, this will start feeding into the inflation measures the Fed is watching. If this happens, the Fed will basically be forced to raise rates for PR purposes. Consider that oil prices rallied like crazy during the 2008 recession. Probably nothing. Anyways, the ninth reporter to ask questions was from Bloomberg. Lo and behold, they asked Jerome about a potential recession. Jerome suddenly morphed into a hawk and said that, quote, "The worst thing we could do is fail to restore price stability." In other words, inflation is more important. It's safe to say that he didn't fully believe what he was saying. Next up was a reporter from the Associated Press. They asked Jerome what's causing inflation to come down. Jerome said that it's a combination of supply chains improving after the pandemic disruptions and a gradual pullback of fiscal policy, aka government spending. The 11th reporter to ask questions was from Bloomberg TV. They asked Jerome why the Fed didn't hike during this meeting if most of its members are projecting one more hike. Jerome said it's because they've been moving fast and now they need to be careful. Put differently, they're a bit scared. The 12th reporter was from Yahoo Finance. They asked Jerome whether the Fed is accounting for base effects and how the government shutdown would impact the central bank. Regarding the base effects, Jerome said yes, they take them into account, hence the lack of CPI concern. Regarding the government shutdown, Jerome said that it could mean the Fed won't get the data it needs to make its interest rate decisions. Newsflash, that is bad because it means uncertainty, and uncertainty means volatility. This was easily the most important answer Jerome gave at this press conference, by the way. The 13th reporter to ask questions was from Fox Business. They asked Jerome whether rising oil prices are a problem for the Fed. What's fascinating is that Jerome first said that rising oil prices will affect consumer confidence and consumer spending by extension. Then he mentioned the inflation part. This is fascinating because it's further evidence to the idea that Jerome is now more concerned about employment than inflation. As most of you will know, managing both is the Fed's mandate. The fact that Jerome's stance on the economy is apparently at odds with those of his peers is even more fascinating. The 14th reporter with questions was from Market News, and they addressed the elephant in the room. They asked Jerome why long-term interest rates are rising. If you were paying attention earlier, you know the answer. From Jerome's perspective, it's mainly because of bond issuance by the Treasury. Then the 15th reporter was from American Banker. Instead of asking about the banks, which aren't doing so well, by the way, they asked about the housing market. Jerome rambled a bit and then said, quote, "In a financial crisis, you have to do what you can to support the economy." If that's not a red flag, I don't know what is. Anyhow, the 15th reporter was from Marketplace, and they asked Jerome whether a decline in consumer confidence would help the Fed bring inflation back down to 2%. Jerome said something to the effect of, "Well, I wouldn't put it that way," meaning yes it would. The Marketplace reporter then followed up with a similar question, and that's whether a decline in consumer confidence would cause a recession. Again, Jerome said something to the effect of, "Well, that's always a concern," which again means yes it would. The 16th reporter to ask questions was from The Economist, and they asked Jerome whether interest rates are effective. After beating around the bush, Jerome finished by saying that interest rates might just have to go higher. By now, you'll know the reporter should have specified the duration of those interest rates. Anyway, the final reporter to grill the big dog was from MarketWatch, and they asked Jerome whether the Fed will start doing surveys to see how low-income households are doing. Jerome said no, even while he confirmed that the Fed's recent outreach found that low-income households are struggling. I guess they just don't care. Anywho, this brings me to the big question, and that's what all this means for the markets. Well, the answer depends on another, more important question, and that's why Jerome suddenly seems to be expecting a recession while everyone else isn't, and why the market's reaction to his speech was all backwards. Some would argue that Jerome's sudden expectations of recession could be the reason why markets crashed. But if that was the case, then long-term interest rates would probably have come down as investors started to buy bonds for safety. However, the opposite happened. Long-term rates rallied. In case it wasn't clear enough, the markets don't like high interest rates. As such, it's probably the rise in long-term rates that caused the markets to crash. Some would argue that it was actually the rise in the US dollar, but Jerome's comments about rate cuts should have actually caused the dollar to weaken. No matter how you slice it, it doesn't make sense. If a recession is coming, then bond yields should be falling. If the economy will stay strong, then markets should be rallying and the US dollar should be falling. And it should be falling a lot because this was literally the first time Jerome talked rate cuts. When you combine this with the fact that Jerome seems to be extremely concerned about the economy, it suggests that there's a much bigger game being played here. It's almost as if Jerome knows something that very few others do. Something that's causing him to lose his cool, which he rarely ever does. Now, we can't say for sure, but we suspect this has something to do with the Fed's fiscal counterpart, the Treasury Department. If you've watched any of our videos about entities like the Financial Stability Oversight Council, or FSOC, you'll know that they always include the heads of the Fed and the Treasury. Given all the bonds the Treasury has been selling lately, it's safe to assume that Jerome has been meeting with Janet Yellen and the heads of other government agencies to ensure these massive sales are going smoothly. Janet herself has confirmed that the Treasury is working with Wall Street to this end. Now, to the public, this bond issuance is to increase the US government's cash pile at the Fed. Behind closed doors, however, this bond issuance could have another purpose, and that's to squeeze the geopolitical opponents of the United States. For context, most governments and corporations have lots of US dollar debts. When long-term interest rates rise, these US dollar debts become more expensive. This means that these governments and corporations must find additional US dollars. Depending on which government or corporation we're talking about, the only way to find more US dollars is to sell other assets. Selling other assets for the US dollar would cause the US dollar to rise, and this would explain why the US dollar rose even while Jerome talked about rate cuts. But that's just half of the story. If the Treasury really is trying to inflict pain on the US's enemies by raising rates, this will affect the domestic economy too. Chances are that this is what Jerome is seeing, and it would explain why nobody else at the Fed can see it. Only Jerome is privy to this information. Only he can truly understand just how high the Treasury is prepared to raise long-term interest rates to ensure that the US dollar and its country of origin remain dominant. Can the US afford to do this, though, given the massive amounts of debt its own government owes? Well, common sense says no, but we're not dealing with a normal financial system, and you can learn all about it using the link in the description. Anyhow, that's all for today's video. If you found it interesting, smash that like button to let us know. If you want to make sure you keep getting interesting content, subscribe to the channel and ping that notification bell. If you know someone who would find this video interesting, share it with them as well. And if you're stacking sats while you wait for the financial system to collapse, make sure you're doing so using an exchange with low fees and always maintaining control of your private keys. If you're looking for either of these, the Coin Bureau Deals page has everything you need. It's got up to $40,000 in bonuses and airdrops on the best crypto exchanges and the biggest discounts on trading fees and hardware wallets. The link to that will be down in the description. As always, thank you for watching, and I'll see you next time. My name is Guy, and I bid you goodbye.